Your bank does not treat everyone the same. It treats your balance like a ranking system. Low balance, more fees. Longer waits, worse rates. High balance, waived fees, better offers, private bankers. Same bank, same logo, different universe. Subscribe and turn on notifications because the system gets easier to beat when you finally see the scoreboard. Section 1. The $432 customer. Nina has $432 in checking. She works full-time, pays bills, uses the same bank app as everyone else. Nothing about her looks irresponsible. But her account lives on a tightrope. One delayed paycheck, one surprise bill, one automatic payment hitting early. That's all it takes. Her phone bill clears before her deposit. Overdraft fee. Her car insurance hits 2 days later. Another fee. Now Nina is short because she was already short. That is level 1. When you have very little margin, the bank does not feel like a service. It feels like a trap door. The Consumer Financial Protection Bureau found that a small share of customers pay most overdraft and NSF fees, and those customers usually have the least room to absorb them. The people closest to the edge are charged the most for standing near it. That is not an accident. The system prices weakness. Section 2, the penalty level. At this level, every dollar is under pressure. Monthly maintenance fees, overdraft fees, late fees, returned payment fees, high credit card APRs. Nina does not need luxury banking. She needs 3 quiet days where nothing goes wrong. But banks do not reward survival. They reward balances. If she calls customer service, she waits. If she asks for a fee reversal, she may hear, "The fee was correctly assessed." That is the painful part. When you need money the most, money costs the most. This is why being broke is not just stressful, it is expensive. Section 3, the first escape. The goal is not to hate banks. The goal is to stop being the easiest person to charge. So Nina makes boring moves. She switches to no monthly fee checking, turns on low balance alerts, moves bill due dates away from payday, creates a small cash buffer, links savings for overdraft protection. Nobody claps when you avoid a fee, but avoiding fees is the first level of financial power. Before money can grow, it has to stop leaking. Section 4, the break-even customer. A few years later, Nina has $18,000 across checking, savings, and a small investment account. Now the bank's tone changes. Fees disappear. Rewards improve. ATM access gets easier. Credit card offers look better. You are not powerful yet. But you are no longer the fee machine. The bank is not giving gifts. It is protecting the relationship because your money has become more useful. You stop being punished. You start being kept. Section 5, the name-remembered customer. Nina keeps building. She pays down high-interest debt. Her savings grows. Her retirement account grows. Her credit profile improves. Now she has $100,000 to $200,000 across accounts. Suddenly, banking feels warmer. A banker calls. Emails get answered faster. Fees vanish before she complains. The bank starts using words like priority, planning, and relationship. Below a certain level, you are processed. Above a certain level, you are managed. But do not confuse attention with generosity. At this level, the bank is not just helping Nina. It is trying to keep Nina. If this opened your eyes, tap like, because more people need to know how banks quietly rank customers. Section 6, the advisor trap. Here is the part people miss. A bank advisor does not automatically mean the best deal. It means you are valuable enough to sell to more carefully. Investment products, insurance, mortgages, credit lines, managed portfolios. Some may help. Some may cost too much. So Nina learns one rule. Personal service still needs comparison shopping. Smart customers ask, what does this cost? What are the fees? What are the alternatives? What happens if I move my money? That is how you stop being impressed by attention and start using it. If you already understand crypto risks and want one place to manage digital assets, Nexo lets eligible users buy, trade, earn, borrow against, and spend crypto from one platform. Check the Nexo link in the description to learn more. Section 7. When wealth gets discounts. Now Nina crosses into serious money. $500,000. Then $1 million. And the relationship changes again. Now the bank may offer better rates, bigger rewards, waived fees, and more flexible lending. This is where the system feels upside down. The person who needs a discount least is the person most likely to get one. Why? Because wealthy clients are profitable. They bring deposits, investments, mortgages, referrals, and estate planning needs. The bank is no longer looking at one account. It is looking at Nina's whole financial life as a revenue stream. The bank is not being nicer, it is competing harder. Section 8. Money becomes collateral. At the highest levels, the game changes completely. Wealthy people may borrow against stocks, bonds, real estate, or business assets. Instead of selling investments, they use assets as collateral. That can create liquidity without immediately selling. But this is not magic. Markets can fall. Collateral can be called. Rates can change. Debt can become dangerous fast. Still, the lesson matters. At lower levels, debt often means survival. At higher levels, debt can become strategy. Nina with $432 borrows because she has no choice. Nina with $4 million may borrow because it protects flexibility. Same word, debt, different reality. Section 9. What a bank really is. So what is your bank? Not your friend, not your enemy. It is a pricing machine. It looks at your balance, credit, deposits, history, assets, and risk. Then it decides what your money is worth. If you have little margin, the bank often charges you for instability. If you have strong assets, the bank discounts you for value. That is the hidden ladder. At the bottom, you pay penalties. In the middle, the pain disappears. At the top, the bank competes for your assets. Nobody announces it. The treatment just changes quietly. Section 10. How to move up. You do not need to become ultra rich to improve your position. You need to stop playing the weakest version of the game. First, remove obvious leaks. No monthly fee checking. No unnecessary overdraft exposure. No high interest balances sitting untouched. Second, build a cash buffer. Even a small buffer changes your relationship with fees. Third, protect your credit. Better credit can mean better rates, approvals, and choices. Fourth, compare banks. Your first bank does not have to be your forever bank. Fifth, negotiate when your balances grow. Ask for fee waivers. Ask for better rates. Ask what relationship benefits exist. Banks do not always reward quiet customers. Sometimes they reward customers who ask. Nina's biggest shift is not opening a new account. It is changing the question. She stops asking, will the bank approve me? She starts asking, what is this relationship costing me? Because the goal is not to impress the bank. The goal is to build enough strength that the bank has to compete for you. At every level, banks respond to leverage. Low balance means low leverage. High interest debt means low leverage. Weak credit means low leverage. Strong cash flow, assets, credit, and options mean more leverage. At the bottom, they charge you for being close to the edge. In the middle, they remove pain. At the upper levels, they sell attention. At the top, they compete for assets. Same building, same logo, different universe. Here's the real takeaway. Banks price you based on risk and value. Low balances can make banking expensive. Higher balances often unlock better treatment. Personal service can still come with sales. The goal is leverage, not loyalty. I'm curious to hear from you. What bank fee annoyed you most? Has your bank ever surprised you? Drop your answers in the comments and subscribe for more educational personal finance content. Thanks for watching.